everybody. This is Colin podcasting about real estate, and welcome to show number 10. Today, my guest is Chris Grenzig from ToroREP, and we talk about his journey going from a failed stockbroker and house flipper to millionaire apartment investor by the ripe old age of 28. He's really got a really interesting journey. He's been through a roller coaster of ups and downs over the last 5 years. I think you're really going to enjoy it. Before I tell you a little bit more about that, I just want to remind our listeners that you can check out my website on colininvestments.com. That's COLIN investments.com. You can get on my mailing list that way. I send out emails every week or so to people with interesting articles I'm reading, links to podcasts I've recorded. You can find a bunch of videos on this website. Some of them are videos of the podcasts I'm doing. Some of them are more general education videos I've put up there. I also have a range of professionally designed real estate reports that you can download. These are like 15, 16 page reports on different aspects of real estate investing. So check it out. You'll also find links on that website to schedule a call with me. If you want to have a brief chat about your own real estate journey, I'm happy to do that. And you'll also find links to my various social media accounts, whether that's Facebook, LinkedIn, Twitter, Instagram. You'll find me in lots of different places. So getting back to today's show, it's a good one. So Chris Grenzig, we spoke about, we started about his first job where he was selling stocks with a company with questionable ethics, to how he and his family spent five-figure sums on real estate flipping courses, how they lost a lot of money employing out-of-state contractors. I've spoke about how difficult it is to do house flipping out of state before. They eventually partnered and did joint ventures with some great multifamily investors. They made millions of dollars investing in their own multifamily and working for a much bigger company doing, 600-700 units at a time. We also speak about how COVID is affecting the apartment investment sector and how it's affecting a lot of the blue collar workers that are there in terms of the eviction rates, the delinquencies that have been building up. We also talk about, as he's a young tech savvy guy, we talk about how to build your brand using social media, whether it's to promote your own brand or to promote your products, and his different tips on time-saving software and news outlets. So a lot of interesting stuff going on here with this young man. He is done very well for himself and he's in a good place right now. So let's move over, and I hope you enjoy the show. Hey Chris, how you doing? Welcome to the show.
Yeah, thanks for having me, bud.
No, my pleasure, man. So tell us a little bit about yourself, mate, where you're from and what type of place you grew up.
Yeah, sure. So I'm from Long Island, born and raised, outside New York, from a town called Wisconsin, part of Smithtown. It's about an hour and a half outside the city. Grew up there. I actually ended up going to Hofstra University from 2010 to 2014. Played Division I soccer there. It's on Long Island as well.
Cool.
I only did 1 year outside of it, so I'm back here. I was living in Brooklyn before COVID hit, but basically been here my entire life.
Okay. All right. And so where did your initial, passion for real estate come from? Did you have family that were interested in real estate or entrepreneurial uncle or something like that? Where did that come from? What kind of got you into it?
Yeah. So it started after college. I didn't really know what I was going to do. So I ended up coaching Division II soccer up in Mass for a year. Came back because I missed New York, missed my friends and family, and got a job coaching, but also got a job as a cold caller at a stock brokerage company. And that was how I started getting into like the business investing world and learned a ton. It was a really good experience, but the morals and values just didn't align with who I was. So I did get licensed. I was there for a little over a year because I wanted to, give it its fair shot. But ultimately,
is this licensed to sell stocks or licensed for?
Yep. So I had my Series 7 and my 63.
Great. It's not easy to get.
I got that in January of 2016. And just coincidentally at the same time, and my mom and my cousin, they bought a flipping course for single family homes and dragged me along because at that time I was like, I don't think this is going to last. I think I'm going to look for something else. They're like, why don't you come check this out? We're going to do it. Maybe you like it. And that was literally knew nothing before that. So the example I like to give is I used to think asbestos was a type of mold. And I learned that weekend that it wasn't because we walked a bunch of vacant properties that were potential flips. And they were like pointing out mold. And I was like, oh, is that asbestos? And they were like, what are you talking about? I was like, oh, I guess I don't know anything. So
hey, if you don't ask the questions.
Yeah, exactly. So then it was the next few months, nights and weekends, getting educated through the program. My mom, my cousin had more experience than I did, so learning from them.
Was this one of those really expensive programs, or was it a little bit more affordable? Or
no, it was 5 figures, mid 5 figures, a little less.
Oh, wow.
So it was definitely a good chunk of change from all of us. And the course
and
is
this
great.
was you, your mom, and your sister. Were you all working?
My cousin.
Or your cousin, normal jobs at the time, and just wanted a kind of a side hustle that could potentially be,
So
career?
my cousin was actually working he had his full-time job, and he was just become an agent. My mom, I forget if she was about to retire or had just retired, and she was also becoming an agent. And it was just a way to like add on top of that. My mom had always talked about getting into real estate more, had never really just had the time or the wherewithal to kind of go do it, and it just came up at the right time, and the three of us kind of got together and did it. So the next several months we tried flipping homes on Long Island, and just flat out failed. Never bought one.
Oh, no.
Never put one under contract. Spent a lot of time, money, energy to do it, but just ran into a ton of problems. Ultimately, it was just a lack of execution on our part, but there were some
So
other
you don't think it was down to the course not showing you practical actionable advice, or were you,
the two problems that
information overload?
I say with the course is that I don't think it was a good fit for us in New York. It was designed basically to come up with quick calculations on renovation costs, holding costs, profit, all centered around the square footage of the house. Now, New York, Long Island is a higher cost of living area, so everything was much more expensive. So we could have definitely, so as it was, it didn't work, but we probably could have taken some time and took the systems and processes and adapted it to our area. The other thing that wasn't quite working out for us as part of the program was basically you get a coach that's supposed to be doing it in your area or very close. There wasn't anybody within, 40, 50, 60 miles of us, if not further. So when we would have conversations with someone, they didn't fully understand our problem. Now, it's a problem that clearly can be solved because I know other people now that do flip in our area and are successful. So that's where I say,
no REIA meetings that you could have gone to, or
well, we started
boys that were doing it.
Yeah, so I've met more of them now because they were a little bit more private. But that's why I say it was a lack of execution on our part, because there are people that are doing it. I know them. I'm friends with them. I've actually talked to them several times. We've had one or two on our podcast as well. So ultimately it comes down on our shoulders, but it just wasn't the right fit. But what happened was we did start going to RIAs and other meetups, and we started learning how other people were doing this out of state. So we said, one of the things we also didn't like is it was thinner margins. It's larger dollars, but thinner percentage margins. So we weren't super comfortable with that either. And my mom and cousin also started talking about trying to find something that had a better tax advantage for them, because my mom was retired. My cousin was a high income earner. They were both getting crushed. Me, I wasn't really making that much at the time, so it was fine. But we started learning about different things. And what we decided to do was out of state. We said, instead of trying to do another course or book or program, let's just partner up with somebody. Let's, sacrifice some profits. Let's put our time, energy, money where our mouth is, and let's see if we can learn that way. So we actually tried to get on like the flipping side with a partner. Nobody really wanted to do it. So instead we lent money as a hard money loan for a guy who was doing a flip in PA. And it went okay. We learned a little bit, but we got introduced to his cousin. His name is John Colin. He's one of the owners at Toro, where I work now. And that's where things started really kicking off. So at first he was going to show us how to buy tax deed properties at auction down in Philadelphia. And we were going to try to flip those or like rehab them, rent them out, and then refi our money out. But we drove down there, probably drove 50, 60, 70 properties between my cousin and I one weekend, and just hated it instantly. It was super
They're not the
rough.
prettiest properties, the tax deed properties.
No, they're definitely not.
No white picket fences and pretty gardens.
Yeah, so it was it was a big shock for us coming from like the flipping world, where you're making stuff like beautiful and immaculate, and we go into these, and we took out the worst zip codes, supposedly, and we just didn't like it. So we came back, we're sitting down having a chat, And John had been transitioning into multifamily. He had probably done 4 or 5 smaller deals, and he was starting Toro at the time with his partner Don, and they were doing larger stuff. He was raising money for a little 8 unit up in Covington, Kentucky, which is right across the river from Cincinnati. And we said, we had gotten our money back from the flip, I think. And we said, hey, why don't we do the same thing? We'll invest passively, and we'll just see if we can pick his brain and, whatever. So we said, hey, we'll invest with you. Can we just learn more about the business from you? And he said, sure. So we started sitting down like once a week, every other week, grabbing coffee on the phone, and just really started clicking together. We were like, hey, we'd love to partner with you on deals, take some stuff off your plate, but come on your side. And he said, sure. So
But you guys are based in Long Island, and he's in Kentucky or Cincinnati.
No, he's in Long Island as well. So
he's in Long Island.
He was right around the corner. Yeah. So the guy who did the flip was also from New York. So these were all people that were doing it out of state. So that's why, we connected with them well. And so we found another 17 units up in Covington.
So did you find an 8 unit and flip it out of state with this local investor that you met?
Well, there was no local investor, so it was John was raising the deal.
Okay.
And he's from Long Island. We had a property manager out there, but he was just managing it. But we came in and we did our intention was to do a BRRRR strategy. However, the financing we got once it was stabilized was not what we hoped it would be. So we just stayed in cash and then eventually sold it. We did the same thing with the 17 unit property too. So in our head, what we had wanted to do was we wanted to just BRRRR a bunch of properties in one area and scale from, instead of 8 and 17, we were hoping to get to, 60, 80, 100, 120 units in one area, and really, do some nice stuff in a market, because it was going through gentrification. There was a lot of coffee houses, a lot of breweries, a lot of, nice little retail places popping up, some new development, some nice condos being put in. So we're like, this is an area where, we can see some stuff happening. We ran into a couple problems that just didn't make that overall business.
How are you getting the renovations done, remotely, or were you doing much in the renovation side with those?
Yeah, so we had a general contractor who's working on it. So we were spending probably about $20,000 a unit, both interior and exterior, to kind of get these properties where they need to be and lease them up. And then that was one of the problems we ran into. The contractor we were using actually stole about $20,000 from us, and he stole significantly more on another project we weren't involved in. And once we had problems with that, we had some problems with our manager as well. We had some problems getting financing that we liked or thought was suitable. We were just like, we can't continue forward with the overall plan because what we thought we could do, just wasn't going how we thought.
It's so difficult to renovate out of state. I mean, I've done it with my business partner. It's very, very hard. It's much more stressful. It's much more difficult to control what's happening on the ground. Somebody tells you a kitchen's been installed, you go up there 5 days later, it's not there. I mean, somebody tells you it's going to cost one thing, it costs another. It's just very difficult, as you obviously know very well, to renovate something out of state. I think investing out of state is very exciting and interesting, especially if you live in a high cost area and you're investing in a high cash flow area. But you found out the hard way, and obviously lots of people have as well, that if you're doing single family or small multifamily and kind of getting general contractors, there's, I don't know what the percentage is, but there's got to be a pretty decent percentage chance that you're going to get burnt, or you're going to get stung, or learn a hard lesson, right?
Yeah, and that's exactly, once that happened, we said, forget the small ones. And we actually, the next deal we worked on was a 82 unit deal down in Jacksonville, Florida, with a manager John had worked with prior and had done successfully and well. We felt way more comfortable with something like that. Having that relationship. She was already managing the property for the seller. So, we called her and said, should we buy this? And she basically said, you'd be a fool not to. Who
are you partnering with in this 80 unit deal? Who's in it with you?
So the same, there was one additional person, but it was, still me, my mom, my cousin, John. And then we had started a meetup as well. Someone from our meetup helped us find the deal and put it together. So there's actually 5 of us on it. Which sounds like a lot, but it actually worked out very well.
80 units, that's a lot to digest. I mean, that's just pretty amazing that you went so quickly so far, especially from finding it very difficult to doing, a flip or renovating an 8-plex or 16-plex. And you just kept going up. You kept scaling up until it got
part
easier.
of it was, John had much more experience than we did, especially at the time. He had done several 50, 60, 70 unit properties, 40 unit properties. So this wasn't his first time doing it. At Toro, they had already closed on a 200 unit property. They were under contract on another 500 units. So he had some more experience than we did. So he was kind of like the bird's eye, just making, kind of organizing. We were helping get everything together, basically doing a lot of the grunt work and, getting cut in for it. So he was just able to take a half step back, a 3/4 step back and say, hey, here's what you guys need to do, go do it. And we were able to put it all together. And, we actually sold that deal 4 months ago. We bought it in November 2017, and it was a killer deal. So it went well.
Are you able to give us some rough numbers on what you bought it for, what you put in, how you exited?
Yeah, so we bought that 82 units for about $47 a door. We were probably all in for around 55, give or take. So with some closing costs and fees, and then we renovated about $5,000 a unit. We probably renovated about half the units, did a little bit of exterior work, but not a ton. And we just kind of, sat tight. We had some agency debt on it. Cash flowed probably about 7% for, life of the deal on average. And then, cap rates just came down. So we got helped by the market. We increased the NOI as well, but nothing, crazy. And we sold that for about 70 a door. So
nice.
We did pretty well. Yeah. I think it was
bought
like
it for 55 a door and you sold it for 70 a door.
Yeah. And so our equity was probably about, it was 55. It was probably about 17, 18,000 per unit. So we weren't far off doubling our money in 2.5 years. I think we had like a 23 IRR net to investors. So we did pretty well.
That's around. Pretty amazing. Now that must have been a good day when you sold that and got that check.
It was good. We sold it during COVID. So we sold it in the end of March. It was actually under contract for 73. They wanted a big retrade. We negotiated it, kind of split the difference, and just said, they'd already extended it twice. We were like, all right, do it if you release your hard money deposit, and waive your right to sue if you don't close. And we're just like, we'll just get the deal done. It's still a great deal, still blew away our expectations for returns. So,
so you only reduced it from 73 a door to 70 to close
it. So it was about $300,000, maybe a little bit less.
Yeah, a lot of people would have taken that deal considering the equity you'd built up and the uncertainty about where that value might have been, a few months later.
Yeah, I mean, the good thing was in the conversation we were having was we had put a 7-year loan on it. So we still had about 4.5 years left.
Great.
Yeah, so we weren't necessarily like, we've got to sell now, our loans come due or anything like that. So if we hadn't done as well as we had, if we weren't so far above our projected returns, I think we may have been more inclined to say no and potentially hold it for another 6, 12, 18 months. But just because it was still, we had done so well, we were like, we can take a little bit less and still do very well.
That's good. So let me get some insights here after, because you had some missteps. You lost money. People stole money. You spent money on courses and tried to do it and it didn't work out. But you didn't throw in the towel. You just pivoted. You just networked and met other people and tried other types of deals and got really good success at it. But what kept you going there? I mean, what was it that a lot of people would have thrown in the towel and just gone back to a safe, corporate job or just kind of licked their wounds and kind of gone back home. And what kept you guys going in it together and sticking at it?
So I think one was I had come from that. So while we were doing that 17 unit deal and while we had closed that and we were starting that deal down in Florida, I quit being a stockbroker and I went and started working for Toro full time. And at Toro, we worked on bigger projects, some that went very well, some that did okay. It was more just, I wanted to be in real estate full time. I knew this is where a lot of people eventually end up going because they see the value in it and how it can help achieve, financial freedom, retire early, whatever you're shooting for. And I had utterly hated my job that I had just come from. So I was like, you know,
Right.
can't see myself not going down this path or having it as part of my path somewhere in the future, whether it's on the side or full time. So I was like, I'm just going to continue to learn and make it work. And, you know, if I want to change in the future, I can always do that, but haven't changed yet. So.
And your mom and your cousin were of the same mindset. They're just like, well, let's just kind of keep going until we find something that works. Real estate is, you know, can be life changing for us. We just haven't latched onto the right type yet, but let's keep going. Were they the same, or were you kind of dragging them along with you with your enthusiasm?
Yeah, so they were definitely both involved. My cousin started fading away because he was still working a full-time job. He actually started crushing it as a real estate agent. I mean, he's built up a really nice business for himself. He started building up a team now. And he also had his first kid. So he just started getting pulled in too many different directions. Yeah. And the other stuff was moving quicker. So he kind of took a back seat. He still invests in some of the deals passively, but he's kind of faded out into the other stuff. My mom also decided to move down to Florida and do some other stuff as well. So she kind of backed away too, but again, put some money in. But she said, like, you know, once I saw you kind of running with it, I was like, you know, you take over, you go do what you want to do. So the two of them have stepped away, but, you know, I still work with John. You know, it's been 4 years now, 4.5 years now, that I've been there, and really enjoy doing it.
So talk to us about what kind of job do you have now? Obviously, you're still an investor. What kind of job do you have with, you know, talk to us about Toro, and talk to us about what skills you had to develop to kind of move up the ranks with them over the last few years, because it sounds like you kind of jumped in at the deep end and kind of kept going.
Yeah, so I joined pretty early. I was the first person they brought on, and they kind of coached me up for the first few months. I mean, I'd already had some experience with the other deals, but, you know, it's a big difference from when you're doing it on the side to, you know, all day, every day, 9 to 5, 9 to 6, 8 to 6, whatever it is. So I was getting coached up a lot in, you know, underwriting, asset management, understanding how the debt works, how the insurance works. I mean, it was a lot of, for me and for them, it worked really well. It was a lot of just by learning through osmosis. So it was, hey, do this, try it. When ultimately you fail, let me know, and then I'll show you how to do it. And I love that because I'm big by learning by doing. I don't read a ton of books. I like podcasts and videos, but, you know, I still learn a lot more by doing. So it was a lot of like, I would listen to podcasts, hear what people were saying. I'd listen to John and Don in the office, hear what they were saying. I would try doing it and, you know, try to pick it up. So after about 6 months, you know, kind of got the ball rolling. I was helping a lot with the asset management side of things. And then eventually it morphed into a role as we started getting more and more involved in Florida, you know, only in Jacksonville right now, but we're looking in other markets. They kind of just said, hey, you know, run our deals there. So, you know, the acquisitions, the asset management, the dispositions, the investor side of stuff. That's basically what I handle today.
Wow. So how many units have you got under management now? What's your asset value like?
Yeah, so we've acquired 7 properties at about 1,000 units. We've sold 2. So we're currently at around like 750, 800 units, somewhere in there. And it's worth, what would it be? 25 plus 13. What's that? I've never really done the math on the assets. I think it's like right around like 60, 65, something like that. 65 million.
And were that's very impressive. 700 units, $65 million asset. How much of that is, you know, were you raising money through syndications from, you know, from passive investors?
Yeah. So all of our deals have some sort of syndication part to it. You know, we co-invest in every one of our deals. Sometimes we'll be 10%, sometimes we'll be, you know, 50, 60%, really depends on the size of the deal, personal finances, stuff like that. So I would say on average, we're probably 20, 25% of the equity, but the rest we raise from investors. So mostly, you know, friends, family, acquaintances, high net worth guys. But we have done several deals with, you know, more institutional investors. So quasi-family offices, private equity funds, you know, funds of funds, stuff like that.
It's amazing. And are you only accepting money from accredited investors, or do you accept investments from non-accredited? Are you able to do both?
Yeah, we do both. Most of our deals are, because we do a Reg D filing. So either a 506B or 506C. and the 506B allows us to raise money from up to 35 non-accredited investors, as long as you can show, I believe it's 3 points of contact before you raise money from them. So we don't really have the need for a 506C. We've done it like on 2 deals. So most of our deals have a handful of non-accredited investors.
Nice. And just in case some of our listeners aren't familiar with it, can you tell us quickly what is an accredited investor?
Yeah. So it is if you've earned as an individual $200,000 a year for the past 2 years, as a joint couple $300,000 for the past 2 years, or if you have a net worth exceeding $1 million, not including your primary residence.
All right. Gotcha. There are a lot of investments out there that are only available to accredited investors, which is obviously very annoying to someone who might have $50,000 or $100,000 saved up and they want to invest it. But, those, supposedly, I guess, accredited investors are considered to be more educated and more willing to absorb any losses, whether that's true or not for a lot of people. I don't know, but
it is, we are very careful when we raise money from non-accredited investors. I would encourage anybody not to have a significant portion of their net worth or capital tied up in a syndication. If somebody came to me and said, "Hey, I'm worth $300,000, here's 100," I'd probably say, you sure you want to do that much? Because if you need that money back, there's no guarantee that we can get it to you. We can try to facilitate a sale of your shares. We can try to buy you out if we have the money available. But these are non-liquid investments. Per the agreements, we're not obligated to get you your money back. We do it as best we can. And oftentimes trying to sell shares in a deal early on, could result in a loss on your money. You may not even get all your money back, just depending upon the offers that come in. So we try to be very careful to communicate that to people up front. We try to make sure we're not taking too much of somebody's money so they're not in a tough position. I think over the last 5 years, we've had maybe 3 to 5 people ask. And so far, we've not had any shares being sold. They just come together. So
that's pretty good. And are you promoting these as like 5 to 7 year investments, 7 to 10 year investments? What kind of timeline are you giving your investors?
Yeah, so we do basically our deals fall in 2 types of buckets. So we either have your more stable value add type deal. Those typically we say 5 to 7 years. We tend to get 7 to 10 years debt. So we try to say our business plan will be a couple years shorter than what the debt is. So if we have to hold it for an extra couple years, we can do. But we also do very distressed and opportunistic deals. So we've bought 2 deals that were, 100% vacant. We bought a couple deals that were 60 to 80% occupied. And by necessity, you have to get bridge debt, which is shorter term debt. It's basically for construction projects. The debt on that is typically 3 to 5 years long. So we're typically only holding those deals for 2 to 5 years.
Okay. And so what your portfolio, is it a mix of A class, B class, C class? Do you have or is there certain niches that you stay in, or certain zip codes that you stay in? I mean, can you talk me through about what kind of diversity is in there?
Yeah, so we only look in, a handful of different markets. So we're only looking in North and Central Florida. So Jacksonville, Orlando, Tampa, and also Pensacola, which is kind of North Panhandle, but we like that market. And then we also look in a handful of cities in the Midwest, Columbus, Ohio, Cincinnati, Ohio, Indianapolis, Louisville, and Nashville. And we did that because we have 2 great managers in each of those areas. We're trying to build up scale in each of those areas to continue to get better efficiencies of operating, as well as we don't spread ourselves too thin. It's easy to check on all our deals if they're all close by. Like you said, we've got before COVID, we would go every 2 to 3 months to go check them out. But then within those markets, we definitely have certain zip codes we won't even look at, typically the worst of the worst. But most of our stuff is primarily C class with some B class stuff.
And so by C class, so you mean that it's like 70 or 80,000 a door, renting for 600 a month, that kind of stuff?
Yeah. So, we've bought stuff for as cheap, because we buy stuff that is distressed and, needs some work. We bought stuff for as cheap as, 10,000 a door to 30,000 a door to 40,000 a door. But our more stable stuff that is, cash flowing and operational, anywhere from 55 a door upwards of 100,000 a door. So just depending upon what neighborhood, what zip code, what market, what the rent is, etc. So we go up and down that spectrum, just kind of depending upon what it is. But yeah, I would say our average rent across our portfolio is probably like $750, give or take, plus or minus $50. I've never done the math. But we're, it's firmly, fairly affordable market rate, but affordable, blue collar workforce housing, whatever you want to classify it as.
So how has COVID affected your vacancy levels? Because I don't know, but I would imagine, it's affecting kind of blue collar workers more than white collar workers that can work from home. Whereas if somebody was working in, in hospitality or travel or in factories, maybe it was, affected them more. How have you been finding it? Or is it some of your projects have done extremely well, they're at 98%, whereas one or two others that are dependent on a local airport or a hotel have been doing badly? How's it been?
Yeah, so luckily we purposefully look for markets that have really good job diversification, so they're not overly reliant on one population. The only exclusion to that is we have a student housing deal in Clarksville, Tennessee. So that one has been a struggle with the ongoing stuff with colleges. We're working through that. For the most part, our property's occupancy has not been affected. However, our delinquency has been slightly affected. So people are still leasing, they're still renting. We're still having people occupied. However, I would say our delinquency is typically in the 1% to 3% range, depending upon the property, the location, where it's at in its business plan. Right now, it's anywhere from 5% to 8%. So still a very manageable range, not anything crazy, but it is definitely worse than pre-COVID. One of the things that is affecting it the most is because most places now have eviction moratoriums. We have about, I would say roughly 3% of our tenants are, just not communicating with us and haven't been paying for, a few months or several months. And whereas, the rest are trying to pay or communicating with us and letting us know what's going on, and we're trying to work with them to the best of our ability. So, if evictions were allowed, it wouldn't be as bad probably, but it's still very manageable currently. That being said, that was with the CARES Act in place. That was with people getting stimulus checks. That was with the people getting additional unemployment checks. That has obviously ended as of July 31st. Today is August 12th. So we shall see what happens this month. Surprisingly, though, our collections, I know Florida better because, like I said, that's my area. We've actually had a better month this month than last month. But, it's still early, so we'll see how it ends. And then we'll also see next month what happens. I would imagine they're going to put another CARES Act in place. I think they're calling it like the HEALS Act or the Health Act or something like that, that will emulate it in some way that will help with that. But it hasn't been done yet, so we'll see.
We'll see. I know, I traditionally buy a lot of properties in foreclosure auctions, 5 or 7 a month, and they've been shut since, I don't know, mid-March, shut for 5 months. So like foreclosures, moratoriums, like you said, an eviction moratorium. There are still some, there are still some evictions happening if it's for, they're not other reasons other than defaulting on a lease. If they're, squatters or things like that. If you've got good lawyers, you might be able to get them out. But again, it's much harder. And let's see what's going to happen. I mean, like you say, you've got 3% of people that traditionally would have been evicted on a normal market cycle if they hadn't passed laws preventing you from doing it. How do you, what do you think is going to happen when they finally lift these foreclosure and eviction moratoriums? Is it going to be bloody for 6 months and then go back to normal? Is it going to be manageable because inventory is just generally so low?
Yeah, I think it's going to be so market dependent, because, you're talking about supply and demand, which is a huge factor in rental real estate, whether it's multifamily, single family, you name it. So if your market has, a lot more demand than supply, then yes, you probably won't be hurt as much. If it's the other way, if there's a lot of people looking for renters and you have a lot of people that aren't looking to pay, than that. However, there is a national shortage. So my guess is it won't be too bad. What will dictate a lot is how the courts handle it when they open up. So, we're anticipating Down in Florida, it typically is a 45-day process, from the time you file to the day the sheriff comes, if it goes that far. We're expecting, a 3 to 4 month process potentially. We really have no idea yet. We're guessing at best.
Yeah.
But we'll see. I expect evictions will take longer. And then we'll also see how that affects the renter pool, because we do background checks on people. And if they have a recent eviction on their record, that is a no-go for us. So It is going to shrink the available buyer pool for apartments. However, we're also investing in areas that are continuing to grow. People are moving to, and if this work from home movement sticks or stays around, I think these areas like Florida, Texas, Tennessee, Ohio, the Midwest, Arizona, Nevada, they'll continue to see people moving there, from places like, New York, California, Northeast, Chicago, et cetera. So if you have a healthy influx of people and not enough supply to meet it, you should do it right. So I don't see anything crazy. That being said, we're now talking about 5, 6, 7, 8 months from now. There's a lot of things that can change between there. Like I said, the new CARES Act, the election, do they shut down places again? How does that affect things? Is there a vaccine? So there's a ton of variables at play as well that, will all have an effect on that too.
Yeah, no, you're right. There's a ton of uncertainty, and anybody that thinks they know exactly how things are going to pan out is fooling themselves. So don't let them fool you. So, with that said, what advice do you have for listeners that have been listening to podcasts that maybe have 1 or 2 rentals and they want to do more, but is now a good time for them to invest in buying a single family rental or a multifamily syndication? What kind of advice do you have for people that want to get started creating wealth through real estate?
Yeah, I think a deal is a deal no matter what. I think just how you look at a deal is going to slightly change. So if somebody came along with something that we felt was good, we would buy it tomorrow. Obviously the debt world is a little bit different now, so people need to stay on top of that and what options are available to them, at what leverage, at what rate, what requirements. I think it was Chase or Wells Fargo, up their credit score requirement for residential loans. That could happen with commercial loans as well, or if you are in the residential space, if you don't meet that new threshold, you may have been able to get a loan 6 months ago, but not today. So make sure you stay up to date on your options. But I think the biggest lesson people are going to learn from this is cash is king, and you can't over leverage not only your deals, but yourself. So if you're getting into real estate and you don't have some sort of cash reserve for your deal, you don't have appropriate reserves baked into your expenses and your underwriting and your business plan, that's where people are going to get hurt. Is this something people should have seen coming? Of course not. However, you should have done, I think too many people did not do a good enough job planning for a rainy day. I think we personally did an okay job. I think we probably could have done a little bit better. I think we got a little, I don't want to say cute, but we weren't as rigid as we could have been, the last 12 months, because that's what everybody does when things continue to go up and up and up. So I think this will be a wake-up call for a lot of people of, especially seeing what happened to the retail sector, the hotel sector, places like travel, leisure, luxury. I'm not saying that these companies wouldn't have gone out of business if they had just planned better. Nobody could have planned for, the retail space not having consumers for 6 months, right? That's a bit egregious. So I just think it's going to show that, hey, this whole movement of, debt is the best and, leverage as high as you can, or, no cash down deals. I'm not saying they can't work. I think people just need to take a harder look or understand it significantly better, because there's a lot of people that didn't fully understand the mechanics behind it and what the true risk was. And I think this will kind of show them a little bit of, hey, here's something that, could make this go wrong, and, you'll lose what you built up.
Yeah, real estate is cyclical, and, I was in real estate through the last cycle, the way up and the crash in 2008, and I had to build a business from scratch again. But there's a lot of people, and including very experienced and successful people that have only been in a boom, that have been doing real estate for the last 9 years, and it's just up and up and up. And obviously if somebody, because of the kind of scars I had from the last recession, I was always a much more cautious investor after, and treating real estate very much as a get rich slow scheme. I mean, if somebody told me in 2011 that there was going to be a boom for 9 years, I'd have been in fifth gear and going hard at it, investing in everything and leveraging everywhere I could. But that was unlikely to be the case in 2011, that it was going to be a 9-year boom. And you never know that. You never know when the crash is going to come. And if you're over leveraged and you're not cash flowing very well and your reserves are low, you're not going to have time to protect yourself in a lot of cases. So you often have to choose between that kind of high risk, fast growth. I mean, if you treat real estate as a get rich quick scheme, sometimes the market will bail you out and you'll make millions of dollars, and other times you'll lose your shirt. And if you treat it as a, with respect, and that is a kind of, look where you're going, have your reserves in place, keep adding to your asset portfolio, but only when you have enough reserves to kind of back them up, then over a decade period or a 2-decade period, I think you're going to do very, very well, regardless of the market cycles. And it's just that kind of high risk, high leverage stuff can turn on you in a downturn. And there's always downturns. Like you say, somebody might have invested in REITs from cinema chains, movie theater chains, and you obviously feel sorry for them. Nobody could have guessed that, movie attendance would drop 99.5% for 6 months, and you can't foresee that kind of stuff. But outside of that, just having your strong reserves in place, and that goes for whether you're one person with one rental or a large company with 1,000 doors. Like you say, have your reserves for that stuff, and you'll, number one, be able to trade through the difficult periods, but number two, you'll be in a better position to take advantage of opportunities that come from the people that weren't prepared.
Yeah, no, I think it's a great point. And I think one thing I do want to clarify, because I do worry, if you want to go high leverage and go high octane, be my guest. My problem is most people don't fully understand what it means. They just see the cash flow, they just see the returns, they just see the upside. And I feel that too many people do not properly weigh the potential downside. They get caught by the amount they can make per month, the amount they can make per door, the percent return they can make on their money, how little money they need, how easy it is. And I know it because we got sold on it for the flipping stuff. So I understand how that feels. And I was in that same place. Mm-hmm. And just for me personally, it's not worth it. But that doesn't mean if you don't understand exactly what it means and you're like, I want to take the chance, I want to try to build this up quick. And, if I want to change in 3 years, I will go for it. But I just think too many people don't understand what it means or fully grasp the risk versus the reward that's involved. So that's why I try to stress it a little bit.
Mm-hmm. No, I think that's prudent, and like you say, there's a lot of people out there, especially the people kind of selling these high price courses that are I don't know what they're like now, but they were very, very bullish. Mm-hmm. Get new credit cards, raise your balances, start putting down deposits with debt. Mm-hmm. I mean, it was all sorts of dangerous stuff that can get you on the ladder and get you on your way. And like you say, if the market can bail you out, and that can give you a boost, you got to you have your eyes wide open. That's for mm-hmm. sure.
There's actually a really good story that I like too that helped me realize a lot too. It's from Barbara Corcoran. I can't find where the interview was. I need to mm-hmm. find it so I can tell people when I talk about it. She did this interview and they said, how did you scale from she started decades ago from, this little shop to one of the top producing brokerages in New York City. And then eventually she sold it. And she said, all we did was survive. So she said, we would do well. We started at brokerage number, I'm throwing out a number 150 or 130, 120, 100, whatever. Mm-hmm. What would happen is, we would move up a little bit, during the good years. But what would happen is when the bad years hit, we were just able to survive. But what would happen is during those down years, my competition would disappear. So we would go from overnight from 130 on the list to 100. Right. So then the next several years, we would tick up a little bit more, 125, 122, whatever, get mm-hmm. To 120, then another downturn. And they go from 120 to 85 and, up and up and up. And she said, just every year, every time we would just survive. And when other people would go out of business, we would stay in. And then when things got good, we would then take all their business and continue to move up. And when I heard that, I was like, yeah, that just makes a lot of sense. Let your competition beat themselves. Yep. And you just stick around and, longevity. And that's why I tend to steer towards that side of cash reserve, stay in business, keep your properties, because the first years, the first several years, the first several properties, they're slow, right? It takes time to save up $20, $30, $40,000 to buy a property. And then you invest it and nothing changes, because what are you realistically making in cash flow on $30,000? Even if it was 10%, you're making $3,000 a year. That's not changing anybody's life. But then you save up another 30, and it takes you a little bit quicker because you have some cash flow. You go buy another one. Then in another couple of years, you go buy another one. But now what happens is that first property is now hopefully worth more. You can refinance, pull out some more money, and it just starts building on top of each other. And it's basically the same thing. And it was just great to hear somebody as successful as her put it in such an easy to understand, at least for me, way to grasp it.
Yeah, you're right. And if I can find that interview, I'll put it in the show notes. If you find it, send it to me and I'll put it in the show notes. But even with a smaller example, I had a guy called Ryan Shaw on our show a couple of episodes ago, a young guy, like you, he's 28 and he's got, I think, 18 tenants, student rentals, but he's got, I think, 4 mortgages, and one of them is nearly paid off, and he's refied the first house to put down the down payment on the 4th house. And the reason he was able to get it all done was because he literally saved half of his money. He was living way below his means. All his friends were going out, nice clubs, nice cars, nice vacations, and he was literally saving half of everything he made and plowing it into real estate and plowing extra cash into his mortgage payments, so that his first mortgage is going to be paid off within 5 years, and then that's obviously going to cash for a lot more that he can use to plow into mortgages 2 and 3, and he's going to have down payments for the 5th house and the 6th house. And that kind of initial discipline was extremely valuable to him. And if you can have that discipline for saving money, especially when you're young, like in your 20s, you can go so far when you're in your late 30s, late 40s. I mean, it's a tremendous advantage to have that mindset early, because I didn't really get that mindset until I was well into my 30s, if other people were further ahead of me.
No, it's huge. It's the only reason I have as much money invested as I do is, my first year and a half, 2 years working, I lived in a 7-bedroom single family home with 7 other guys, paid $500 a month. And if you know New York, Long Island, $500 a month does not get you a lot, if anything. So it was not great. Then I've lived with roommates my entire life. And then when COVID hit, I'm living in my mom's place. Like, I'm just, staying flexible and saving money. So that's the only way I've built up to what I have now. And it's really awesome. And when you were talking, there's a really good chart I like to reference. It's in a book called Quitting Like a Millionaire. So if anybody's interested in retiring early or how to do that, it's a really great book, very easy read. It's about a couple. They built up to $1 million by the time they were 30. They retired, and they basically live on residual income traveling the world on like $40,000 a year, and they pay 0 taxes on it. But what's really great in that book is they have a chart. It has nothing. It has no dollars on the chart. It has percent saved on one axis, and on the other axis, it's how quickly you can retire. And it's basically saying the more you save per year, significantly quicker you can retire. And it's a really great chart because it breaks down exactly what you're saying. If you save 10% a year of your income, it's going to take you until you're 60, 65. If you save 80% a year, you'll retire fairly quickly. So it really just depends on, now obviously if you save 80% of $10,000, it's not going to get you far. So it does matter a little bit what you're making, but the chart itself is a very good visual of, it breaks down like, several different lines. So
I'll check that out. What's it? Quitting Like a Millionaire? Is that what you said?
Yeah, Quitting Like a Millionaire. I forget who it's by, but
I'll look it up.
It's a fairly popular book.
Okay, I'll look it up. Thanks a million. All right, let's wind up soon. I think this has been really interesting, Chris. Because I know you're very tech savvy, I want to ask you about social media, because a lot of people want to use social media to build their business and promote their brands, whether it's their personal brands or their product. I know you're pretty good at that. You're very active on social media. So what tips do you have? And I'm including like people like me. What tips do you have for guys like me who are still figuring it out, who want to build up a brand using social media? Yeah. What kind of hacks have you learned?
So there's a couple, but the most important one is don't overthink it and just do. Because what really hit home for me was I was in this space probably about 2.5, 3 years ago, And I was like, I really want to, start doing some stuff, maybe podcast, maybe talk more, maybe do social media. And I was like, but, why would anybody listen to me? Right. Like, I was probably 25, 26 at the time. I'm 28 going on 29 soon. I even still have that feeling now. I'm like, who the hell is listening to a 28-year-old?
Mm-hmm.
But I realized two things. I realized one, if I'm at level 5 of 100, I can help people that are at levels 4, 3, 2, 1, 0.
Mm-hmm.
So there's that. And two, Joe Rogan, who has the top 5 podcasts, just got a contract for 100 million plus with Spotify. He posted a video of his first ever podcast he did. And it was the absolute worst video I've ever watched. It was atrocious. They didn't even realize that they were recording for like 3, 4, 5 minutes. There was like these terrible graphics going over them.
Mm-hmm.
And I just looked and I said, all this guy did was he just started doing and he just didn't stop. So for me, it's don't overthink it. Just do and just try to fix little things and get better. And just, try things, because that's the only way you're going to figure out if you like certain things or not. I don't really enjoy typing, writing, doing things like that. I tried it, but it just wasn't something I found enjoyable. So I've steered more towards doing video and audio type things. So coming on podcast, doing webinars, doing different videos, doing our own podcast. For me, it's much easier, much more natural, much more enjoyable, to be perfectly honest.
Mm-hmm.
So that's the route I've gone more. But if you're somebody that's a writer or an artist or a drawer, you can go that route as well. So, I think you just start to learn as you do and you try, and just realize that, most people are not scrolling down your feed to see the stuff you did months ago. They're just seeing the most recent stuff you do. So you'll continue to get better. You'll continue to put out stuff that you like more. And the God's honest truth is people love to see the process too. They love, right? Like, like the real fans of bands are like, oh, I was this fan of this band before they were big. Yeah. It's the same concept. People want to be, your follower or your fan before you blow up or do anything cool or make it nice. Cause that's, they found you first, right? That's been around for ages with bands. It's the same concept. So just don't overthink it. Start with a photo of whatever, type a few lines and just go do it. And, just stick around and don't judge yourself. There's days, there's weeks, there's months where I don't do anything, because I just don't feel like it. So I just take a break, and there's nothing wrong with that either.
Okay. Some good advice there. And I agree. Just a lot to be said for stop thinking about it and just do it. Just don't overthink it. Don't try and make it perfect. Just get going, start your journey, and you'll figure it out along the way. There's a lot to be said for that, especially when it comes to something low risk like social media and creating a brand and creating posts and posting thoughts and images. So yeah.
And if you really don't know what to do, and if you don't know what to do first, and you're listening to this podcast, take a screenshot, go on Instagram, post the photo, tag Colin, tag me, write a couple sentences. There you go. First piece of content, and then just go from there. So it's literally as simple as that. Don't overthink it.
Mm-hmm. That's cool. So any other useful software tools that you can share with us that you recommend to friends and colleagues that have made a difference to your life?
I mean, there's a bunch. It really depends what you want to do and how sophisticated you want to get. One piece of software I am in love with right now that I would encourage people to at least explore, and it's been useful for me. It's called Monday.com. It's a task management software, but we use it for social media. We use it for our deals. We use it for our corporate stuff. I use it for communicating with other people. I use it to send video clips to our video editor, our podcast. It's awesome. It's super robust, but very user-friendly. It's not super expensive either. I think they even have a free version, or it might just be a free 30-day trial. But it helps keep me on task because I don't have the best memory. I don't just remember to do things. So whenever I'm like, oh, gotta do this, just type it in, tag myself, set a date. I get email updates and, a lot of stuff. So
and that's Monday.com, cool. Like the day of the week.
Yeah. Yep. There's other ones too, like, similar one is called Asana. It's very, similar type thing. So you just type in task management software, you can see a bunch, but that's the one that we use and I really like. We use ActiveCampaign for, our newsletters and, our lead capture and our CRM. We use for our investor portal, we use a company called Juniper Square, but it's a little bit more robust than most people need. So there's other ones like IMS or InvestNext. Those are the only other two I know. I'm trying to think what else we use. We use G Suite for a lot of our stuff, but a lot of people do.
I love Google. Love Google Suite as well.
Some little ones that are cool. Calendly is really cool. So setting up podcasts, setting up calls, super easy. Syncs with your calendar, which is huge for me. I really like Linktree too for like Instagram and social media. It's basically a one-click URL that puts a bunch of links on a page. So if you want to link your podcast, your YouTube, your website, you can link them all there. So there's a bunch, but those are some good ones.
Awesome, man. Awesome. So before we finish up, are there any websites or books you'd like to recommend to people that want to accelerate their real estate journey?
So I'm not the biggest reader. I will say if you have an interest in syndication, Joe Fairless has an awesome book on it. It's called The Best Ever Apartment Syndication Book. It's not super cheap. It's like $45-$50, I think, last I checked. But it is a great breakdown of our business from A to Z. It's almost, like a mini handbook, but not a hard read. I don't really have, Quitting Like a Millionaire was pretty good. I like that. I'm not the biggest reader. But for like social media side, I like, Gary Vee's podcast. There's some, good other marketing ones I forget off the top of my head. Those are the biggest ones, really.
That's cool. And what about, do you look at real estate news a lot, or do you any websites you use for that, or do you just get that?
Yeah, I kind of browse through a bunch. It really depends. So there's NREI online, Housing Wire, Forbes, the couple newsletters like Morning Brew, Robinhood Snacks. We're subscribed to the Wall Street Journal, the New York Times. Trying to think if there's any others. There's Inside does a bunch of newsletters for different things. So there's a bunch out there, but there's not like one I'm like, this is the best.
Yeah. No, look, you can't depend on one news source for all your news. You're going to have a pretty narrow, worldview if you do.
For sure.
Well, look, tell us, before we wind up, Chris, tell us a bit about your podcast and how people can reach out to you.
Yeah, so our podcast is called The Real Estate Investing Experience. It's on any podcast channel as well as YouTube. We also have a Instagram account where we do some different clips and good moments from it. It's the REI Experience on Instagram. So if you want to check that out, go hit it up. If you want to learn about our company, Toro Real Estate, you can go to ToroREP.com, TOROREP.com. If you're interested in investing, there's an investor questionnaire. Just fill it out and someone will get in touch with you. And if you want to get in touch with me, best place to do it is social media. So the two main ones are Instagram at Chris.Grenzig or LinkedIn. You just search Chris Grenzig, you can find me. I usually get back to people in if not a day, two.
Sounds good to me. All right. Appreciated all your insights, Chris. Thank you very much, mate.
Yeah. Thanks for having me.
So there you go, folks. That was show number 10 with Chris Grenzig from ToroREP. I think he's an impressive young man. I really admire his grit and determination and how he picked himself up after some pretty strong knocks early on in his real estate career, and which would have, put a lot of people back in corporate world or back in licking their wounds. But he kept going. He kept learning. He networked. He eventually worked his way up where he was able to do joint ventures with experienced, stable partners, and now he's a very experienced multifamily investor in his own right. And I gotta admire that. He's done really well for himself. He's had a pretty short real estate investing career, but it's been a very eventful one. And fair play to him. And I look forward to keeping an eye on where he goes and how he navigates his way through the kind of choppy waters in the apartment business in the years ahead. I think he's going to do just fine. I'm also admirer of his kind of social media prowess. He's a great way of communicating with people and communicating with investors. And glad we got him on the show. Hope you enjoyed those insights that he provided as well. It's always good to get these young, tech-savvy, intelligent young men to talk about their journey. It's a nice mix with the older, experienced investors, and we're going to have some of them on the next show. So hope you enjoyed that show with Chris. And always don't forget, if you are enjoying these shows, please do give me some feedback. Give me a good rating or a review on the podcast app that you use. They're very helpful. Share it with friends and family if you think they're going to enjoy it as well. And of course, check out my website, colininvestments.com, COLIN investments.com. You can schedule calls with me, download reports, see all of the other podcasts, check out a bunch of videos I've put out there, and get on my mailing list for future hints and tips and launches. So that's it from me today. Thank you as always for listening. I really appreciate it. I'll be back soon with show number 11. But for today, this is Colin Murphy signing out. You guys take care. Bye-bye.